Japan's bond market just broke and it's about to hit the US hard. For decades, Japan's government bond market was the definition of boring. Low yields, zero drama, total predictability. Global investors didn't buy Japanese bonds for profit, they bought them for safety, a financial anchor in a volatile world. But something just changed and it happened fast. Alright, now let's get back to the topic. Here's what just went down. Japan's 40-year government bond yields broke above 4% this week. That might not sound like much, but this is the first time it's happened since these bonds started trading back in 2007. We're not talking about a gradual climb either. Yields spiked to around 4.2% in one trading session. That's not a trend, that's a rupture. And here's why it matters. Japan's entire economy has been built on the foundation of dirt cheap borrowing. Near zero rates for decades. That system just cracked, and the shockwaves aren't staying in Tokyo. They're already hitting Wall Street, rattling equity markets, pushing up gold prices, and triggering alarm bells about the yen carry trade, a trade that's been the lifeblood of global liquidity for years. So what's driving this chaos? Politics. Japan's Prime Minister Sanae Takaichi just called a snap election for February 8th, and she's not being subtle about her agenda. She's campaigning on what she's calling major policy change. Translation? Massive government spending, big fiscal stimulus, looser budget controls. Bond traders heard that loud and clear. More spending means more borrowing. More borrowing means more bond supply. And in a country that already has debt sitting somewhere between 200% and 250% of GDP, that's a red flag the size of Mount Fuji. Takaichi isn't hiding her plans either. Back in November, she rolled out a $135 billion spending package. Then she floated the idea of suspending Japan's 8% sales tax on food for 2 full years. For regular households, that sounds great. But for anyone holding Japanese government debt, it sounds like a fiscal disaster waiting to happen. Because here's the thing, Japan's debt load used to be manageable. Why? Because interest rates were basically zero. You can owe a fortune if it doesn't cost you anything to service that debt. But the second yields start climbing, the math flips fast. And that's exactly what's happening now. Bond traders started dumping long-term Japanese debt the moment Takaichi made her announcement. Prices fell, yields surged. The 40-year bond got hammered the hardest, but 30-year and 20-year bonds weren't far behind. In just 3 weeks, 40-year yields jumped from around 3.6% at the start of January to over 4%. In bond market terms, that's an earthquake. Now here's where it gets technical for a second, but stay with me because this matters. Short-term bonds are mostly controlled by central bank policy. Long-term bonds? They're driven by confidence, by trust, by whether investors believe a government can actually pay back what it owes without destroying its currency. Right now, that trust is being tested. One trader called this a 2 standard deviation event. In plain English, panic selling. And it raises a critical question. Who's going to buy all this debt? Traditionally, Japan had a huge domestic buyer base. Pension funds, insurance companies, conservative institutions looking for stable, long-duration assets. But that base is shrinking. Japan's population is aging, balance sheets are stretched, and the appetite for government bonds is fading. Earlier this week, Japan held an auction for 20-year bonds. Demand was weak. The bid-to-cover ratio came in below average. That's a signal. Investors aren't rushing in to support the market. They're backing away. And that's where this story stops being just about Japan and becomes a global problem. Japan is the largest foreign holder of US Treasury debt. For years, Japanese investors have borrowed yen at rock-bottom rates and invested that money overseas. In US Treasuries, in corporate bonds, in equities. It's called the yen carry trade, and it's been one of the main engines of global liquidity. But when yields in Japan rise, the logic of that trade breaks down. Why borrow in yen, take on currency risk, and invest abroad when you can earn close to 4% at home on government bonds? It doesn't make sense anymore. If Japanese investors start pulling money back home, and there are signs that's already starting, it's going to tighten financial conditions everywhere, including the United States. Case in point, on the same day, Japan's 40-year yields crossed 4%, US 30-year Treasury yields climbed to around 4.9%, the highest level in months. That's not a coincidence. Long-term borrowing costs are rising globally, not because the economy is booming, but because one of the world's biggest sources of capital is rethinking where it parks its money. Now, Japan's central bank, the Bank of Japan, is in a tough spot. If they step in aggressively to cap yields and keep borrowing costs down, they risk tanking the yen even further. But if they do nothing, volatility could spiral out of control. Either way, someone loses. And globally, higher long-term yields act like a weight on risk assets. They compete with stocks for investor capital. They tighten financial conditions. And they threaten to unwind years of leverage that was built on one simple assumption, that Japanese rates would stay near zero forever. That assumption is now under serious threat. This is why global investors are suddenly obsessed with Japan. Not because of inflation data or GDP growth, but because of politics, because of Takaichi's fiscal plans, because confidence in Japan's ability to manage its debt without triggering a crisis is starting to crack. Japan can still spend, no one's questioning that, but it can no longer pretend that borrowing comes without a cost. What happens between now and the February 8th election could reshape not just Japan's fiscal future, but the trajectory of global interest rates for months to come. And in a world that's already on edge, that makes Japan's bond market something no serious investor can ignore. Let me know in the comments, and don't forget to like, subscribe to the channel, and hit the notification bell so you never miss an update. See you in the next one.